Okay, let's go ahead and go through the solution to the constructive retirement assignment. So we're going to assume that Big owns 90% of Little's voting stock. Whoops, I need to go ahead and alter this. Copy, paste as values. Okay, so Big owns 90% of Little's voting stock. On January 1st, 2016, Little issued bonds with a face value of $147,000. The bonds were dated January 1st, paid interest of 8% annually. Bonds had a term of 13 years and were sold at 97% of face value, a 3% discount. On January 1st, 2019, so 3 years later, Big purchased all of these bonds on the open market at 95% of face value. Big uses the partial equity method to account for the investment in Little. Assume that both Big and Little use straight line amortization. Required, prepare appropriate elimination entries arising from this transaction for the year of acquisition and the year after that. Okay, so let's go ahead and get all of our ducks in a row here. What do we have? Let's first look at the issuer. Let's see, let's go ahead and find the book value of the bonds. So the initial discount these bonds had an initial discount of 3% of $147,000 or $44.10. The annual amortization, okay, that $44.10 was divided over the 13-year term of the bonds. So annual amortization of $339.23. The remaining discount at acquisition, we can do this one of two ways. We can either say the remaining discount is going to be the initial discount minus 3 years of amortization, or we could say there are 10 years left to go at $339.23 per year. Either one should get us to the same place. Let's go ahead and do it in what might seem to be a more reasonable fashion. So the remaining discount as of January 1st, 19 is the initial discount of $44.10 minus 3 years of amortization at $339.23 per year. So the remaining discount is $33.92.31, which means the bonds have a book value of the face value minus that remaining discount. They were repurchased for 95% of face value, and so they had a book value of $143. They were repurchased at $139. So the collective entities saved about $4,000. So there's going to be a gain on retirement of $39.57.69. Now let's go ahead and see what the two companies have at the end of. Let's set this up efficiently. The issuer at the end of 2019, end of 2020. Okay, the issuer has bonds payable, and the face value doesn't change. Bonds payable, $147,000. The discount on bonds. Now here's where you need to be careful and where the acquisition date becomes very important. This remaining discount of $33.92.31, that was as of 1/1/19. It is now 12/31/19. So that remaining discount has been decreased by another year's worth of amortization. And the issuer also has interest expense equal to the coupon rate times the face value plus the annual amortization. And again, these bonds were issued at a discount. Amortization of a discount increases interest expense. So this interest expense of $12,099.23, that is the coupon interest. And again, the coupon interest, just for reference, is 8% of 147. Or $11,760. That's the coupon interest, to which we add the amortization of $339.23. Discount on bonds for the second year, they have another year's worth of amortization, so that's falling by $339 per year. They're using straight line amortization, so the annual interest expense is the same thing every year. Let's see, little was the issuer, big is the buyer. Now what does big the buyer have? They've got their investment in bonds, and they've got interest revenue. Now the investment in bonds, they initially, well, let's go ahead and read a little information off to the side here. The initial purchase discount, again, Big bought these things at a 5% discount. They bought them at 95% of face value. So the initial purchase discount was 5% of $147,000. That's being amortized. Again, these bonds had a 13-year term. They were constructively retired after 3 years. 2016, 2017, and 2018 have elapsed. And so the annual amortization is going to be that $73.50 divided by the 10 remaining years. And so now we're in a position to, let's go ahead and one more thing. The initial cost was 95% of the face value. Okay. So Big the buyer at the end of 2019, their investment in bonds, again, the initial cost was $139,650. That's after deducting a discount. That discount, which initially started at $73.50, has been being amortized through $735 per year. So the carrying value is going up by $735 per year. Their interest revenue is again going to be the coupon interest, 8% of face value, plus the annual amortization. And again, straight line amortization, so it's going to be the same each year. Okay, so we've got all of our ducks in a row here. Now we can go ahead and do our elimination entries for 2019 and 2020. So 2019, what do we have to do? We have to eliminate the bonds payable. And again, at this point, I'm just pulling stuff right off of my little table here. Bonds payable, 147. We also have to eliminate the, let's get rid of all the credit balance account first. So that's a credit balance, debit, debit, debit. Interest revenue is a credit, we have to eliminate that. We have to eliminate the 3 debit accounts also. So we're going to go ahead and credit discount on bonds. We're going to credit interest expense. And we're going to credit investment in bonds. Okay, this entry does not balance, hopefully. To make this thing balance, what have we got? We've got about $160,000 on the debit side. We've got about $155,000 on the credit side. So to make this thing balance, how much do we need? So let's go ahead and say we got that plus that minus that minus that minus that. We need $39.57.69 to make this thing balance. And by not an amazing coincidence, that is the amount of the gain on retirement that we were looking for. Okay, let's go ahead and go on to 2020. Again, a lot of these things are going to stay the same. The bonds payable stays the same. The interest revenue stays the same because we're using straight line amortization. The discount on bonds has changed. Now the discount on bonds is $2713.85. Interest expense is the same as it was because, again, we're using straight line amortization. The investment in bonds has changed to $141.120. And finally, now we're carrying forward the remaining realized but unrecognized gain. And this is where we have our 2 questions. Was this upstream or downstream? This was an upstream transaction. Little was the bond issuer, so the non-controlling interest is going to be involved. Second question is, for the parent's share, is the parent using the full or the partial equity method? The assumption was that Big uses the partial equity method, which means they didn't adjust their investment income, which means their retained earnings is misstated. So we have to adjust retained earnings. Okay, how much do we adjust this for? Well, at the simplest level, if you want to live dangerously, you'd say, well, I trust all of my other work. I need a plug figure of that plus that minus that minus that minus that. That's the plug figure I need to make this entry balance. I'm going to take that 3561 and split it. This is a 90% owned subsidiary. I'm going to split that 90/10 between the non-controlling interest and the parent. If you wanted to be a little more precise, not more precise, if you wanted, this is perfectly precise, if you wanted to be a little more logical about this, you'd say, look, of this 3957 realized but unrecognized gain, how much was recognized via the disparate interest revenue and interest expense that the individual companies recorded? So basically what I would do is say, okay, I'm going to think in terms of carrying forward the income from the previous year. So plus credit minus debit, this is what we're carrying forward to the following year. Okay, I guess that's it.